Hello, I'm Marcus Brix with the CattleFax Closing Bell. Today's CattleFax Closing Bell is sponsored by Zoetis. Take control of your cattle feed additive choices. When you choose feed additive solutions from Zoetis, you gain more. More options with the broadest range of feed additives on the market, more cattle performance with improved gains from start to finish, more support from our production specialists and nutritionists. Make the choice to get more. Visit cattlefeedadditives.com today. On Wednesday, March 21st, the Federal Reserve decided to raise the federal benchmark funds rate from 1.5% to 1.75%. This was the sixth fund rate increase since December 2015, the first under new Fed Chairman Jerome Powell. Central bankers are expected to raise interest rates 3 more times through the remainder of 2018, and possibly 3 more in 2019. An increasing interest rate typically makes for a stronger currency. Higher interest rates attract more foreign investment than a country with lower rates, increasing demand for and the value of that country's currency. Counterintuitively, though interest rates were raised this week, the U.S. dollar index was down 30 cents by Thursday afternoon. The index is a measure of the relative value of U.S. currency against the currency of several major countries and the Eurozone. While interest rates do influence the U.S. dollar index, the index is also dependent on things like economic strength and balance of trade. Protectionist trade policies like the recently announced steel and aluminum tariffs could strengthen the U.S. dollar if imports of those commodities decline significantly. For example, lower crude oil imports in 2015 and 2016 meant less U.S. dollars entering the foreign market, sending the index to multi-year highs. The fear of retaliatory tariffs is weighing on the U.S. dollar index today, as gains from steel and aluminum tariffs could be more than offset by new tariffs on our exported goods. In the short term, a weaker dollar index provides a benefit to exports as U.S. goods are cheaper to buy abroad. For this reason, historically you find a negative correlation with the dollar and commodity prices. This is especially true in grains because multiple countries can ship a near-identical product. While commodity funds have been in a more risk-off trading pattern for livestock, the low dollar is a contributing factor for investment in grains. Subtracting the short contracts from the longs across corn, soybeans, and wheat, we find net investment in grains is the highest since October 2012. Non-coincidentally, peaks in net investment in grains can be matched historically with lows in the U.S. dollar index. Though non-commercial net long in corn is roughly twice as many contracts larger than net long in soybeans today, relative to total open interest, they are remarkably close. Soybean non-commercial net length as a percent of total open interest is at 24% today versus 22% for corn. Even for Chicago wheat, non-commercials have been net long in the past 2 weeks, after being net short in all but 5 weeks in 2017. Thanks for watching. Remember to visit CattleFax.com to become a member and receive the latest market news and analysis.
The beef business has never been for the faint of heart. The pressures are real. The volatility is extreme. The risks are big, but the opportunities for success are there. So how do you sort through it all to decide which way to go? For more than 50 years, CattleFax has led the way. We're the time-proven leader in research, analysis, and information, equipped with the industry's most powerful database. Our team is impartial, objective. Our vision is global. Our focus is you. We provide a direct line of contact with you, our client, to the CattleFax team with our daily updated website, modernized mobile app, or the traditional phone conversation. CattleFax, the deciding factor. Become a member at CattleFax.com.